Hi guys, welcome back to my channel. So today I'm going to do a group statement which have a principle of IFRS 3 together with IFRS 10. So required of this question, they want us to prepare a pro forma journals together with a balance sheet section. So if you take on my previous video, I did the introduction. I introduced the principle of IFRS 10 together with the video that I did which introduced the principle that we have to go through in terms of IFRS 3. So in this question, this is examination question that can help you to master the topic, the all principle that I introduced on the previous videos. So let's start. So we have all information. So the information that we have is for Mondi Ltd, which acquired 80% of ordinary share in CAPITEC Ltd for amount of 850,000. So they also give us the equity account for our subsidiary, which is CAPITEC Ltd. So in this case, Mondi Ltd is a parent because the company holds 80% of share, which in this case we assume that Mondi Ltd is a parent because we have not given in further information which can prevent Mondi Ltd not to be a parent. So if the company is a parent, as I said on the previous video, it simply means that the company is going to be required to consolidate the financial statement for two companies. Okay, let's proceed. Then they said on 1 July 2015, assets and liability of CAPITEC Ltd were considered to be fair valued with exemption of land which was carried at 150,000 below its fair value. Then on the acquisition date, Mondi Ltd elected to measure non-controlling interest at their proportionate acquisition date. Okay, then they said CAPITEC Ltd's equity, both companies have 31 December reporting period. Okay, then let's proceed. They also give us financial statement, which is a balance sheet for both company, for Mondi and for CAPITEC Ltd. And when we proceed again, we found that we have been given a statement of change in equity for both companies. Okay, then let's proceed. Again, they also give us the additional information. Okay, let's start with our pro forma journals. Remember guys, every time if they requested you to prepare a pro forma journals, start with the analysis. Why? Because analysis is a part of the calculation which is going to earn you a lot of marks. So don't forget to start with analysis. It doesn't matter whether they ask analysis or not. Prepare analysis. Whenever they ask you the journal, you need to start with analysis. Okay, let's prepare our analysis. So analysis is a balances from our subsidiary which we are going to allocate to ourselves as a parent company. Okay, then we're gonna have a total column. Then the first part is at acquisition. At acquisition simply means that is the date that we purchase what? Our company that we are owning here. Okay, this is analysis of the name of the subsidiary of CAPITEC Ltd. Okay, so we purchase 80%. This side is Essence, this is Ed, then our NCI, non-controlling interest, is going to be 20%. Okay, what are we going to allocate ourselves? We simply allocate ourselves a net asset. Remember, net assets can be given as a total assets minus total liability, or they can be given as a what? As a equity. Remember, equity is a what? Equity is a net asset. Okay. In this case, we have been given equity part, which is share capital, and we also have retained earnings. Okay, then the amount that we have been given under share capital, they give us amount of 250. This is the total, and they also give us amount of 500,000. Okay, 500,000. Let's proceed. Now again, remember they said on 1 July 2015, assets and liabilities of PERCO were considered to be fair values with the exemption of a land which was carried at 150 below fair value. Remember, we are dealing with the external issue or external case. If it's an external case, everything must be measured at fair value. Okay, now we found that there is a land which has been measured below a fair value by 150, which means that we have to add 150 of land under our net assets in order for us to do what? To measure it at fair value. Okay, now let's allocate. It's gonna be 250,000 multiplied by 80%, which is going to give us 200,000. Then the remaining of NCI will be 50,000. Okay, let's proceed. 500,000 of retained earnings multiplied by 80% is going to give us 400,000. Then NCI will be 100,000. Okay, now again let's proceed to land. Our land is 150,000, which is going to give us 120,000 and 30,000. Okay, then now from there we can be able to determine whether it's a goodwill or it's a gain. Okay, firstly we must get the total of what we purchase. Okay, we own a net asset of 200,000 plus 400,000, which is 600, plus 120, which is going to be 720,000. Now let's take how much we paid, which is consideration transfer. Okay, our consideration transfer, we paid amount of 850. Okay, they said we paid amount of 850,000. Okay, now we can calculate the total on the other side. It's gonna give us 180,000. Okay, again on this side we also have to calculate a total. 250 plus 500 is gonna be 750, 800, 900. Okay, it's gonna give us amount of 900. Okay, now we are done with at acquisition part. In this case, you can be able to do the journals for at acquisition part. Okay, before we proceed, let's do the journal for at acquisition part. Okay, the blackboard is too short, but I'm gonna try to squeeze this journal this side. Okay, or before we go to our journal, let's first complete our analysis. Let's also go since acquisition, then we go to the journal. Okay, now on at acquisition we start with retained earnings at the beginning of the current year. So this balance, we are looking to the changes that happen on the retaining earnings from the date that we purchased this company until the beginning of the current year. So in this case, we purchased the company on 15 July 2015 and our current year is 2017. So if you take our reporting period is ending 31 December 2017, which means that is our current year started 1 January 2017. Simply means that we are looking for changes that happened between 1 July 2015 and 1 January 2017. Okay, let's open the brackets. The first one that we have to take is the retaining earnings at acquisition, which is 500,000. Okay, then now we compare with the retaining earnings at the beginning of the current year. Remember guys, we take the one for subsidiary. Okay, if you go on your analysis, you're gonna find the amount of 931,917. Okay, from there, remember you also have to check if we have any journal that is going to affect retaining earnings from the date of purchase until the beginning of the current year. Let's check. They said on 1 July 2017, Mondi Ltd bought a further 120 in Perco Ltd for existing shareholding of 300,000. Okay, for today's lesson, we are going to ignore the change in ownership. I'm going to do another video which is going to cover a change in ownership. Okay, this is another standard, not form part of IFRS 10 and IFRS 3. Okay, then number 2, they said Mondi Ltd sold inventory with invoice price of 300,000 to Perco Ltd, Mondi Ltd in a gross profit of 20% on the cost price. The following balances existed in the book of Perco Pty Ltd for inventory purchase from Mondi Ltd for 2016 and 2017. Okay, we have the inventory which was purchased last year. But remember, before you adjust guys this transaction, check who purchased the inventory, who sold the inventory, which book of the company has been affected between these two companies. Okay, in this case we find that Mondi is the one who sold. A parent sold to a subsidiary, and subsidiary is the one who recorded the inventory with a what? With profit. Subsidiary record inventory with what? With profit, which means that we have to reverse that amount of profit to subsidiary's account. Okay, then we find that for last year inventory was 85,000, which means that 85,000 we need to multiply it by 28%. Okay, the profit markup is 20%, not 28. We are going to say 100 divided by 120. Then in that case, we are saying that we are looking for what? We are looking for amount of profit that have been recorded by the company, because the principle of IFRS 10 said we have to eliminate any profit that made between intra-group. In other words, they are saying that it's not allowed as a two companies that are in the same group to make a what? To make a profit. They don't have to sell to each other and make a profit. Okay, if you are looking for calculation which is go straight to the answer, you have to say At 20%, you are looking for profit, divide by what you have, which is 120, because that 85,000 include what? A profit, which means that we are going to say minus 14,166. If you say 85,000 multiplied by 20 divided by 120 is going to give you 14,666. Okay, we have to deduct that amount because it affects the date from 1 July 2015 until January 2017, because it's for 2016. Okay, so this amount also have a journal that you have to prepare, which is also going to affect the retained earnings. Okay, because it's opening inventory. You know how to eliminate opening inventory. Okay, it's fine, you're gonna see it when we do the journal. Okay, then we can open from there. Then after that you can calculate. Okay, you have to start by 931,917 minus 500,000 minus 14,166. Okay, then it's gonna give you amount of 417,751. Then you allocate 80%, which is going to be, now you have to write on sin side, 334,201. Okay, then our non-controlling interest will be 83,550. Okay, then we proceed. Okay, now we have to go to profit for the year. Profit for the year. Okay, the first amount that we have to take is a profit of subsidiary. We have to allocate ourselves a profit that made by a subsidiary. Okay, which is 241. Okay, is this amount, which is 241,951. Okay, then from there you said, okay, from there we have to check on the transaction if there is any amount which is going to affect income statement of the subsidiary. Okay, if you check, Mondi is the one who sold inventory, which means that Paco didn't record any sales because he bought, he didn't sell. Okay, then which means that we are going to skip the one for inventory. Then number 3, they say on 1 January 2017, Mondi Ltd entered into a loan contract with Paco Ltd. According to the contract, Mondi will transfer amount of 200,000 to Paco Pty Ltd immediately, and Paco Pty Ltd will repay the loan in 5 annual installments of 50,000, and the interest charge on a loan is 7.9308%. How does subsidiary statement affected? It's going to affected by the means of expense. Remember, interest is part of income statement, which is going to affect a profit and loss. Okay, because he borrowed a loan to a parent, is going to pay interest expense. So the amount of 50,000 of installment is not recorded under income statement. Repayment, we record it under balance sheet. Okay, only interest, which means we are going to say 200,000 multiplied by 7.9308%. The interest, in other words, we are going to reverse it. When we reverse the expense, we add it back by 15,861. Why are we reversing? Because it's not allowed for two companies which is in the same group to do what? To make a profit and to sell to each other. It's not allowed. Okay, let's close. Then from there, we have to say a total plus okay, then it's gonna give us amount of 257,812,6. okay, let's not round, it's fine. Okay, then after that we have to allocate 0.8 or 80%, which is 206251. okay, then the other side is going to be 51,563. okay, now let's proceed. We also have the other amount. Let's check if we have dividends declared by subsidiary. Yes, we have dividends which declared by subsidiary, which we have to allocate ourselves. Okay, it's gonna be a dividend paid by subsidiary. So a subsidiary pay a dividend of 137,500. Never take the parent's amount, guys, when you prepare analysis. Okay, 137,500. Then allocate yourself 137,500 multiplied by 80%, which is 110,000. Then 0.2 is give you 27,500. okay, so if you are requested to do a total, guys, you just have to calculate the totals below and you get the totals. Alright, I think that part is not gonna be a problem. Okay, now we have to go to our journals. This is the first calculation that you have to show before you start doing your journals. Okay, now let's go to the journal. Remember all this information that I'm going to crash here, we are going to use it when we prepare our journals. Okay, let me crash this point. Let me crash. Just make sure that you have this information on the other side so that you will be able to see that this journal is coming from this information. Okay, so guys, when we talk about the group statement, this is very simple chapter, which the principle remain the same, the principle play in one side. Okay, now let's do our pro forma. Okay, let's prepare our pro forma journals. Okay, let's start with the first journal, which we have to eliminate the investment. Remember, guys, once we meet and we are in the same group, we are not allowed to recognize investment as we have investment. Why? Because now we are together. It's like when you paid a lobola to your wife. You can't say you have the 60,000 as a family that you have paid lobola. No, that money is no longer belong to you now. It's no longer belong to the family that you are staying with your wife. The money has been held by the family, which means that you can't say you have what? You have 60,000. This is the similar case with this group statement investment. You can't say you have investment of 850 on the group. Okay, so firstly we have to reverse our net assets. Okay, we have retained earnings whatever that you debit, always on every question paper, you will find it debited. This journal doesn't change. Share capital. Remember, we also have a land. Okay, then after that, you're gonna credit investment. Remember, investment is an asset which was debited. Now we have to do what? To credit. Okay, then the amount, we have to use those totals, guys. Don't use the one that we allocate. Use the total of 250,000. Okay, it's 500,000. Then 250,000 here. Then our land is 150. Then our investment is amount of 850,000. Then we also have our NCI, which is 108. So in our case that we are doing now, we ignore the fact of deferred tax. However, I'm going to do the other video which is going to also involve a deferred tax. Okay, this is the first journal that you have to deal with. Then the second journal is a retained earnings at the beginning of the current year. However, in this case, you are just allocating the NCI. The NCI is the last balance that we allocate. If you check here, this balance of NCI is the one that we are going to do what? To recognize. Okay, we found that it was 83,550 from your analysis. Okay, also we have to recognize NCI from profit of the year, which we are going to debit NCI. However, you have to indicate that it's a profit and loss, and this one is SFP. Okay, then the amount is 51,563. 51,563. Okay, let's proceed. The last one is dividends. Okay, we're gonna have dividends. Received together with dividends paid, and we have our NCI. Okay, let's check. So now we are going to have amount of the total was how much? The total was 137,500. Then we allocate the amount of 110 together with 27,500. Okay, so this is what you have to do on the first journals, which we just copy and paste from your analysis. Okay, because we don't have a space, let's crash this information and we go to elimination journals. Okay, now let's first go back to our question paper. If you check on our question paper, we have transaction number 2, which is about the inventory. So we have 3 categories of inventory which you are going to find in every question paper, which is very, very simple. Okay, number 1, we have inventory which was sold during the year inside the group. What you have to do, you have to eliminate those inventory in full, which means that you have to say a sales, you are cancelling, in other words. Then the cost of sales on the credit, then you write the amount of 300,000. Then the second one, guys, even we have case of deferred tax, this one is not going to be form part of deferred tax. Okay, now let's proceed. The other one is opening. The opening, of course, you're going to say retained earnings, then you said a cost of sales.